Howdy, Jacob here. Today we're looking at the company Eversource Energy, ticker symbol ES. So we have an electrical utilities company with nearly $21 billion market cap and over double enterprise value of $43 billion. So a lot of net debt. Currently 4.53% dividend yield. I think this is going to be one of those companies that doesn't make any cash, so they go into debt. Let's see if I'm right though. 7.2 billion long-term debt, upwards of 20 billion, so over double in 10 years, nearly triple. That's not great. All right, so cash from operations 1.6 billion, 1.6 billion up to 1.9, 2.4, 2 billion. I mean, it looks like that's been an increase of 20%, but their property, plant, and equipment has gone up over double. And so their capital expenditures are increasing way faster than their cash from operations, which is having the company show a little free cash flow over here and then negative over here. And that's very visible through looking at both their debt and dividends, to where the company wants to show that they're a very strong company paying out dividends. But again, this is why we have to look at um, their financial statements. So right here, their cash flow statement, we can see that in the last 5 years, they have not made free cash flow. So that means property, plant, equipment is the capital expenditures, what it takes to just keep the business running, essentially. And that is outdoing their cash from keeping their operations. And so to to keep the dividend in place, they have to issue debt to make up for the cash flow that they're not receiving to pay this dividend, as well as what appears to be making acquisitions. Looks like they've been also issuing quite a bit of debt, quite a bit of common stock as well, increasing the number of shares, which is decreasing an individual's shareholder value through issuing shares. And so this is going to be another ugly one, but let's start making some assumptions here. So I think classic utility company probably going to increase with inflation. Don't see any reason to have an increase on their PE and price free cash flow. Um, as for margins, let's put 12%, and then again, they don't make free cash flow margins, so that 2% is a fluff number just to see what we get here. 1% increase on shares. They can't afford this dividend, but yeah, it's going to be ugly. I mean, again, we've had multiple companies like this before, where if a company doesn't have free cash flow, then they just have to either issue shares of common stock or issue debt to fund the dividend. And so this entire screener is looking for companies that are paying a good dividend. We're confident that the dividend will last and that maybe they'll even increase it, so you can get even more excess free cash flow in your retirement days, or if you just want excess money through dividends. And so, to me, right now, this isn't even a company that I want to look at until they can somehow produce cash flow, free cash flow, which I don't think they can, because we see that their capital expenditures have over doubled and their cash from operations are nearly the same. And so, yeah, the excess equipment that it takes is increasing their revenue and probably their net income, which maybe we can see over here. Yeah, it's been nearly almost double on the net income side, but that means nothing if you can't truly produce free cash flow, which is the lifeblood of a business, which is used to pay out dividends, buy back shares, make acquisitions, reinvest in yourself, or pay down debt. And they're just issuing debt to fund the rest of these projects. So, long-winded way of saying this is a company that I'm just not even interested in at all. But thank you, and I hope you have a good rest of your day.